Hey everyone, welcome to the fourth quarter market outlook from Cetera Financial. As I've known, I've talked to you many times before. This is Goldman. I'm the Chief Investment Officer for Cetera Financial. I work closely with Wild Wealth Management to provide support in terms of markets and other perspectives. So with that said, welcome to our fourth quarter market outlook. What I'll do today is talk about our three themes for the rest of this year and probably for the next 12 months, but also more importantly, talk about the election. I'm not going to tell you who's going to win. I don't know that yet, but I think more importantly, I'll talk to you about, regardless of who wins, what the ramifications are from an election standpoint. So with that said, let me just dive right in. So I've talked to you so many times about this, but again, this is such an important reminder. Here are our three themes that we laid out at the beginning of 2024. And these themes are still valid. And I, in fact, think they're going to continue to be valid for the next 12 months or so. First theme is that the Fed goes from being a foe to a friend. Simply put, the Fed is going from raising rates to cutting rates. They already cut rates on September 18th. We do think the Fed will continue to cut interest rates. That's great news. I'll talk about the ramifications in a second. But there is one caveat. I do think the Fed got a little too aggressive in terms of cutting interest rates, and I'll explain that in a second. Our second theme remains that we don't see a recession. We think the economy cools, slows down into a soft landing. And as a reminder, a soft landing is when inflation rises, as it did a few years ago, but the Fed raises rates to slow inflation, but does not push us into a recession. It's a very rare event when the Fed avoids a recession. You know, we've talked about this before, the many mistakes the Fed has made in the past, but we think they get it right this time. And our third theme is probably the most relevant to our money, our portfolios, is we do think a lot of market volatility is going to continue to pick up, continue to surge. But the good news is that any pullback, any sell-off in the market should be pretty short-lived because there's some really strong fundamentals on a go-forward basis. So let me dive into some of these themes. So the first theme, again, is that the Fed cuts interest rates. And as I mentioned before, the Federal Reserve, cut interest rates on September 18th. That's great news because when they cut interest rates, borrowing costs, credit card rates, mortgage rates tend to come down a little bit, which makes it cheaper to buy things and in theory stimulates the economy. That's great news. And the markets like this. But the question I have is, did the Fed cut rates too fast, too quickly? So let's talk about the Fed. So we all know, and I have talked about this before, the Fed has a dual mandate. And the dual mandate is simply this, that they want to make sure that inflation slows down, and they want to make sure inflation is kept in check or slows down. And also, they want to make sure that we all have jobs. That's their dual mandate. So everything the Fed does is towards those two goals of keeping inflation in check and making sure we all have jobs. So if you look at inflation, inflation is slowing down. There are many ways that we can measure inflation. We can go to the grocery store and see the increase in price of milk, the increase in price of eggs. We can look at the consumer price index, producer price index. There's so many measures out there. The Fed has a favorite measure. It's called core PCE. And core PCE is shown here. It's their favorite measure because it's pretty diversified. It has less exposure to rent and shelter inflation, and it gets updated pretty frequently to be more relevant to our current economy. So long story short, they love core PCE. If you look in this chart, see the red arrow, it's slowed down. So whether it's trailing 3 months, 6 months, 12 months, the core PCE, the Fed's favorite measure of inflation, is heading towards their 2% target. That's great news. Inflation is definitely slowing down. But remember I said this before, the Fed has a dual mandate. They want to make sure that inflation is kept in check, and they want to make sure we all have jobs. What caused the Fed to shift a little bit from raising rates to cutting rates is, first of all, inflation is slowing down, but more importantly, the job market is starting to slow down a bit. So there's a lot of lines here on this chart, and I apologize for that, but look at the two lines at the top. The two lines show what's called JOLTS, and JOLTS is basically a survey of jobs and job openings and so on. It's a long story short, it's a great indicator of the labor market. If you look at the top line, the purplish line, you see that the hires are starting to come down a little bit. The Fed is watching this. That means companies are hiring fewer and fewer people. That's a sign of a weaker labor market. If you look at the middle line, is that reddish line that's kind of going up and it goes down. At the end, that's quits. Quit rates are slowing down. So basically, if you and I are afraid of not being able to find a new job, we're less likely to quit. So this is a way for the Fed to say, okay, the labor market is slowing down because hiring is slowing down. and fewer people are quitting their jobs because they're afraid they can't find another job. So overall, the labor market is slowing down. And you've seen this. If you look at the unemployment rate, it was at 3.4%. It went up to 4.3%. It's come back down a little bit. But overall, the labor market is slowing down. And what the Fed is doing is getting in front of any worsening of the labor market. Because again, it goes back to the dual mandate. Keep inflation in check and make sure we all have jobs. But this is where I think it's a little interesting. When the Fed cut interest rates on September 18th, they cut rates by 0.5%. I do think that was a little aggressive. I think they should have cut rates by 0.25%, because basically the labor market is slowing, but it's not as bad as the Fed indicates. Yes, you're seeing some indications that the labor market is weakening, as I mentioned before, but more importantly, though, labor force participation is increasing. More people are coming into the workforce. And by the natural effect of numbers, as more people come to the workforce, the unemployment rate increases a little bit. You look at this chart. This is such an important chart. This shows labor force participation between people between 25 years old and 54 years old. And look at that surge on the right-hand side. We are now back to levels that we saw back in 1999 and 2000. More people are coming into the workforce. And because not everyone is being hired as they come into the workforce, just a natural effect of our economy, the unemployment rate does increase a little bit. So I do think the Fed was a little bit too aggressive in terms of cutting rates by the amount that they did. If you look at this slide, this is another way to look at our employment picture. This is initial jobless claims. So when someone unfortunately loses their job, they file initial jobless claims. As you see here, jobless claims are at near a 5-month low. So that's a sign of a pretty strong labor market. And if you kind of factor in where it is right now, around 220,000 jobless claims per week, that suggests that the unemployment rate stays around 4% for some time. So overall, I do think the labor market is pretty good. It's not great because it has slowed down, but not as bad as the Fed has alluded to. So speaking of the Fed again, it's not just the labor market, but other parts of our economy are also doing pretty well. So if you look at this index that I'm showing you here is called the City Economic Surprise Index. And I know we've talked about this before. And what the surprise index does, and I do apologize, there's a spelling mistake on this slide. So anyways, what this slide shows, it shows that the data has gotten better and better since the Fed alluded to cutting rates back on July 31st. So what this index shows is that every time a data point comes in better than expected, every time an economic report beats expectations, just better than people had anticipated, the line moves higher. If you look on July 31st, when the Fed said, hey, we might be cutting rates later this year, boom, all the data came in better and better, whether it's retail sales, whether it's services, whether it's even jobs. Just if you look back at the September payroll report, the market anticipated this to be at 150,000 new jobs. It came in at 254,000 jobs. And jobs were not just in the stable parts of our economy. It's in the more cyclical or more economically sensitive sectors like leisure, hospitality, manufacturing, and construction. All that taken together is that the data is getting better, and maybe the Fed did not need to cut rates as much because things are not as bad as the Fed had thought. So with all this said, though, if you look at probabilities, and this is what, long story short, what this shows is that what the markets are saying, how many more times the Fed will cut interest rates before the end of the year. Long story short, the market is saying the Fed will cut rates 2 times before the end of the year. So probably another 0.25% rate cut in November and 0.25% rate cut in December. Of course, the data changes, but the markets expect the Fed to cut rates 2 more times before the end of the year. And here's an important point. Even though the Fed has just started cutting rates, banks have already provided our economy a rate cut, in essence. So if you look at this chart, this is what's called the Senior Loan Officer Survey. And this is a survey of bank lenders, senior loan officers at banks. And they're asked a simple question. Are you tightening lending standards, or are you making it easier to borrow money? And if you go back to March 31st, and this is on the far right-hand side where you have that big spike, on March 31st of this year, about 55 or 56% of senior loan officers said, we are tightening lending standards. We're making it more difficult to borrow money. But if you look at the end of June, on June 30th, when the same survey was done, now it's about 20%. So 20% of senior loan officers are actually making it tighter or more difficult to borrow money. All this together, and this is before the Fed indicated they're going to start to cut interest rates. All this says is that money is easier to borrow, loans are a little bit easier to get. This is in essence a rate cut in addition to the Fed providing rate cuts. So the first theme is that the Fed cuts interest rates, and they have been. But more importantly, though, I do think the Fed may have gotten a little too aggressive, and I'll talk about this later in terms of market volatility. So the second theme is that the economy cools into a soft landing. We do agree that the economy is cooling. It is slowing down. You see this already. But I think more importantly, we don't see a recession for the next 12 months. So let's talk about this. Why are people talking about recession? And I saw this survey on CNBC. It said that 59% of Americans, so 59% of you and I, believe a recession, that we are in a recession. Again, CNBC said 59% of us believe that we are in a recession right now. And I do agree that we are having what's called almost like a K-shaped recovery where lower income households are struggling because you have high gas prices, high food prices, high inflation. So yes, lower income households are struggling, and you can see this in some of the performance of some of the retailers, like the dollar stores, relative to much more the luxury retailers. And I can rattle off the names, but I can't really talk about stocks. So long story short, overall the economy looks okay, but there's definitely this split in terms of some segments are doing well and some segments are doing poorly. But with this said, though, why are 59% of Americans, of you and I, saying we are in a recession? Because we're so used to a recession driving down inflation. If you look at this chart, remember that Fed's preferred measure of inflation, core PCE? What I've done here, I've plotted it since like 1960. And what you see here is that all those red circles is that inflation is going up. Then the red circle is when we hit a recession and it goes down. So every single time inflation is high and we want to bring it down, we've had a recession. But if you look on the far right-hand side, see that red arrow that goes down? That's where we are today. We have not had a recession, yet inflation is slowing down. So in the back of people's minds, inflation needs to be impacted by a recession to slow it down. But this goes back to one of my earlier points. I think the Fed got it right by raising rates pretty quickly, but just right amount to avoid a recession. So one thing we talked about this before, but remember, recessions, we all learned in school that in Economics 101, we learned that a recession is 2/4 of negative GDP. But that's actually wrong. A recession is defined by a group called the NBER, National Bureau of Economic Research. And it doesn't matter from a time standpoint how long the economy is weak. In fact, if you look at 2020, we had a recession that lasted 2 months. What the NBER does is they look at 6 factors, and you see them here, like personal income, employment, like industrial production. And you see, based on these factors, they dictate if we are in a recession or not. And if you look at these 6 factors here on the right-hand side, none of them are anywhere close to being a recession. Some are slowing a bit, but none are close to a recession. I think this is why I personally don't think that a recession is coming anytime soon. Of course, let me take a step back. Recessions happen all the time. They're part of our economy, but this is why I don't see a recession for the next 12 months. If you look at our economy today, there are 2 areas that are clearly in recession: housing, because of high interest rates, so high mortgage costs, and manufacturing, because we bought a ton of stuff during COVID because it was a services-led recession where we just stopped going to bars, stopped going to restaurants, we hunkered down and we just bought stuff. So those 2 areas are in recession, housing and manufacturing. Manufacturing has been in recession for about 18, 19 straight months. And of course, housing with more high mortgage rates and a low inventory. But here's the good news. See those red arrows here? These are 2 indicators that are the most forward-looking indicators for housing and manufacturing. It's building permits and it's manufacturing new orders. Both fell dramatically around 2021, 2022, as expected, but now these are starting to stabilize, if not improve slightly. I think this is such an important data point. This says that likely the worst is behind us in terms of manufacturing and building permits. Great, 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 great news. This is why I think we're going to avoid a recession. So long story short, there's concerns about a recession. There's concerns that we are in a recession. I do think that the areas in the recession today are stabilizing. Also, the consumer is doing fairly well. Also, you're seeing with the Fed cutting interest rates, borrowing costs are coming down. This should stimulate the economy if we do have any weakness. Long story short, we just don't see a recession anytime soon. So first theme, the Fed cuts rates. Second theme is that no recession. We have a soft landing. Third theme is that market volatility is going to increase. It has been increasing. We've seen these big fluctuations, but we think the market will increase for a variety of reasons, like market dynamics, the Fed, and of course the election. So let's go into some of these right now. So let's think about the markets. So since October 27th of last year, the stock market is up over 40%. Why is October 27th such an important date? That's the correction low. So if we take a step back, a correction is when stocks fall from peak to trough by 10% or more. And a nasty bear market is when they fall from peak to trough by 20% or more. So our last official correction was from July to October of last year, and it ended, the low point was October 27th. We also had a almost correction in July of this year where stocks fell from peak to trough by 10%, but during the day, they didn't close down 10%. So almost a correction, but not quite. So regardless, since the correction low of October of last year, stocks are up about over 40%. That's a big move in stocks. Look at the arrow. Look at that surge in stocks. That's a really big move. The ramifications are quite a few. First of all, this causes valuations to be pretty high. Stocks become extremely expensive. Remember we talked about this before? The PE ratio, price earnings ratio of the stock market is a great valuation tool. The higher the price earnings ratio, the more expensive stocks are, the lower the cheaper stocks are. And price earnings is price of the stock market divided by earnings. You look at the far right-hand side, today we're around 21.5. That's a pretty high number. If you look at the long-term average, it's about 18 over the past 10 years. If you look at the last 20 years, it's up about 16. The PE ratio is up about 16. So stocks are pretty expensive. You can have high expensive stocks. That's a normal part of investing, but you need low interest rates and you need low inflation. We have neither of those right now. They're headed in the right direction, but basically, this is the stock market saying everything needs to be perfect. We're pricing in absolute perfection, absolute perfection. Nothing can go wrong. That's what worries us, especially with high expectations, especially around some of these technology and AI companies. So you have high valuations, high expectations, and this is a shocker right here. Look at this. This is concentration. If you take the top 10 stocks in the S&P 500, and there's 500 companies in the S&P 500, the top 10 stocks represent 35% of the index. That's a lot of risk in just 10 stocks. The other 490 stocks are about 65% of the index. So you have high valuations, high concentration, and high expectations. We think this causes some type of pullback or at least market volatility. But you look on top of that. So another risk that's on top of market risks is that there's more risks from the Fed. So remember I said before, the Fed maybe is a little too aggressive in terms of cutting interest rates. Yes, they should cut interest rates, and I agree, but maybe a little too aggressive. One reason we think they're aggressive is that you see bond yields rising. So bond yields indicate more risk, indicate more concern that maybe inflation comes back. I don't think inflation is going to surge like we saw before, but there's a chance that inflation, it's called reflation, where it comes back into our economy. And the bond market is worried about that. If you look here, this chart shows the 10-year Treasury yield, which is a common Treasury yield that we tend to focus on. 10-year Treasury yield has surged since the September 18th day when the Fed cut interest rates. So back on September 18th, the 10-year Treasury yield was at 3.6. Today, it's over 4. It's like at 4.5, 4.6%. That's a very short move in Treasury yields. This is another risk for the market that we have to be very careful about. This could cause uncertainty because when interest rates move higher, borrowing costs move higher. And remember, the 10-year Treasury yield, that's where mortgage rates tend to be based upon. So this is why you're seeing some choppiness in mortgage rates, despite the fact the Fed is cutting interest rates. Another expectation for market volatility is just going to be the election. So let me talk about the election for a little bit. So if you look at this chart, there's a lot of data here. What this chart shows is that the 60 days before an election tend to be pretty volatile and pretty weak for the stock market. So if you see here, since the election days, since 1948, since the end of World War II, On average, the stock market has fallen by about 0.6%. So it's been pretty weak. And you see some fluctuations there. But long story short, before the election, stocks tend to be pretty weak. If you look at the period after the election, so from election day to inauguration day, stock market tends to be very positive. On average, over those same time periods, up 1.5%. And this makes sense because going into the election, you've got uncertainty, what's going to happen, fear, uncertainty. But then after the election, whether it's a Republican winner, a Democratic winner, a split Congress, gridlock, whatever it is, a risk is taken off the table because you know what is going to happen. You know who is the winner and how the government will look. So that's why stocks tend to do a little bit better after election day. And there's some discussion that maybe a lot of this positiveness between election day and inauguration day has come in before the election. But again, regardless of what you look at, expect a lot of market volatility. So what do we know about the election? And keep in mind, as I talk through this, I am not a Republican. I'm not a Democrat. I'm an independent. I'm in the middle. Okay. And I'm also here to talk about the ramifications of whoever wins. So please don't come back to me and say, oh, you are a Trump supporter or you are a Harris supporter. I'm not. I'm an independent person. So keep that in mind. So what do we know about the election? We know, as best as we can tell, is that the Senate likely goes Republican. So here's some betting odds from a website called Macro Micro. And if you look at the red line in the middle, this shows the probability based on betting odds that the probability that the Senate will go Republican. And if you see the red line on the far right-hand side here, it's about 60%. And this makes sense because if you think about the Senate is fairly split between Republicans and Democrats. And then something really important happened over the last, say, 6 months. In West Virginia, you saw Joe Manchin retire. Joe Manchin is a Democratic senator. West Virginia is a Republican state. That seat likely goes Republican. And then if you look at Montana, Montana is a Republican state being led by a Democratic senator. And John Tester is a senator from Montana. But he is really struggling against his Republican counterpart. And what's interesting is that he's trying to distance himself from the Democratic Party. So if you think about the Democratic National Convention, he didn't go to it. He skipped it because he's trying to distance himself from Harris and from the Democratic Party. You want to know where he went instead? I thought this was kind of funny. I know this is unrelated to our topic, but he went to a Pearl Jam concert because he's a big fan of Eddie Vedder. I mean, that's like if my boss had a wedding or a big event, I'd be at that event. But John Tester, to distance himself from the Democratic Party, he went to a Pearl Jam concert. So likely Montana, based on the odds, and likely West Virginia goes Republican. This likely puts the Senate on the Republican side. The House likely goes Democrat. And if you look on this chart here, again, another slide from Macro Micro, the blue line shows the probability of the House going Democrat. And it's at 70% right now. Again, this fluctuates, of course. But this makes sense. I mean, you think about there are more Republican seats up for a re-election. So some of those will probably be lost. And then if you think about Kamala Harris, because she took the Democratic nomination, now you have a lot more likelihood that some of the House, she'll get more support from California and New York, which has a lot of seats up and running. So long story short, House likely goes Democrat. So I do think that we'll have much of a gridlock in Congress. What about the presidential election? And it's a complete toss-up. This data I show you here is from our friends over at PIMCO. PIMCO is a money management firm over in Newport Beach, and they have some great data. So I do think that it's a toss-up right now. It's too hard to call who's going to win the election. But PIMCO had some really great data I really want to share with you. If you look at this chart, this slide, it shows 7 states. And these 7 states are the key swing states. And what you think is what's very important is that really the polling, first of all, don't trust polling. We know this. The last few elections, polling has been terrible. But polling says a lot in terms of what each candidate needs to do. So let me explain that in an example. So if you look at the top row is 2020 polling. And you see, for example, let's go to Arizona because a lot of you are watching this, live in Arizona. So Arizona, back in 2020 polling, Biden was leading Trump by about 5%. In 2020 outcome, the second row, Biden only won by 0.3%. So this says to me, especially when you look at current polling, that whoever wants to win these swing states, they need to be much more aggressive and much more higher in terms of how they're doing relative to the other candidate. In fact, you're seeing like Harris and Trump are extremely close in most of these states. This is a complete toss-up for the election, for presidential election. So we're going to watch this extremely carefully. So extreme toss-up. But here's the key point. There's obviously some ramifications of who wins and who loses, but whoever wins is facing three issues that they're going to have a tough time with. Actually, four issues. Let me give you four. First of all, gridlock in Congress, so not much can be done. Second of all, an expensive stock market. So stock market volatility could put pressure on whoever wins. Third of all, you have a slowing economy. As the economy slows down, then you have to probably provide more fiscal support to help consumers. And then lastly, the most important point is that we have a ton of debt. We have so much debt in our economy right now relative to GDP. If you look at these bars, this data is from the U.S. Congressional Budget Office. It's a nonpartisan group. And you see the dark lines are debt relative to GDP, and the light blue lines are expectations, are projections. And you see this is going to increase dramatically. In fact, our fiscal year just ended back on September 30th, and we had what was it, $1.8 trillion of $1.8 trillion budget deficit. Third highest budget deficit we've had in our country, except for 2020 during COVID and 2021. So long story short, debt has increased dramatically for our economy. This makes things very difficult. If you look at our economy today, you have I think it was like $950 billion over the past 12 months is tied towards interest rate payments. So whoever wins the election, they are going to have a tough time dealing with this because, again, debt is a problem for our economy, but it's a long-term problem that any candidate tries to tackle this problem. It's going to be a long time for him to get anything solved. So a lot of times, the president, I don't ramble, I apologize, but a lot of times, they aren't going to touch it because by the time it gets solved 20 years down the road, either president, whether it's Trump or Harris, they're out of office. So anyways, overall, our third theme is that market volatility surges. But here's the good news. Even if stocks pull back, even if we have a weakness, even if we have a sell-off in the stock market, we think it's going to be very short-lived. Why? First of all, earnings. Earnings look pretty good. Earnings drive stock prices. If you look in the middle of this chart for 2025, those big bars in the middle, those are earnings for next year. Those are large cap, mid cap, and small cap earnings. They look pretty amazing, 15, 16, 18% year over year. Stocks tend to price in events about 6 to 9 months in advance. Eventually, they'll start to look at 2025 earnings, and that's a great number. The other reason why we think any pullback will be short-lived is what we've seen over the past year and a half, is that we have a lot of cash on sidelines, a lot of money market assets. So right now, if you take cash in money markets or deposits in money markets, it's about $24 trillion. If you take just money market assets, it's about $6.5 trillion. Regardless, there's a lot of money on the sideline. And whenever we've seen stocks pull back, whether it be July of this year, whether it was that correction of October of last year, whenever stocks pull back, because we aren't headed towards a recession, money comes in because they had been waiting for better valuations. So we see a lot of cash on the sideline waiting to get in for better valuations. This is great news. This is why I think any pullback, any potential correction will be short-lived at most. So 3 themes 2024 for 2024 and probably for the next 12 months. Number 1, the Fed cuts interest rates, but maybe they cut a little too much. 2 is that the economy cools to a soft landing, no recession. And number 3 is that volatility picks up a bit, uncertainty about the Fed, about market dynamics, about the election. So as I always say, what do you do? What are your big takeaways? Number 1, be diversified. Diversification is a boring strategy, but it works. Exposure to different parts of the market, like bonds and stocks, like US and non-US, like value growth. Just being asset allocated, being diversified is such a way to mitigate uncertainty and risks. Second thing to take away is that what do you do? I mean, how do you get diversified without being too aggressive or too conservative? Sit down with your advisor and go over your portfolio. Go over your whatever's going on in your life, because they need to be aware to make sure your portfolio is not too aggressive or not too conservative. So with that, thank you so much. If you want to follow my team and I on Twitter or X, excuse me, it's Cetera IM, or if you want to follow me, Gene Goldman, that'd be great if you did follow me. I want to thank you for taking your time to listen to me speak about markets and the economy and the election. Really appreciate that. Thank you so much. And I need to show you these disclosures at the end. I won't read these to you, I promise I won't, because if I do, my Boston accent will come out. And that's about it. And with that, I just want to thank you so much. Thank you.